Welcome once again. This is Pinnacle Professional College. Today we are going to be studying audit, and I hope you enjoyed the session. If you haven't subscribed to our YouTube channel, please, you are missing out. We post here free lectures, and so kindly subscribe to the channel for all your, for all your lessons when it comes to accounting. Okay. The amazing news we have is that we have a Telegram group, and this is the link to the Telegram group, t.me/Pinnacle Professional College. Pinnacle Professional College. So please join our Telegram group. We post tips there, we post our videos there, and you can freely enjoy all of them. Okay, so let's move on to our agenda for today. As I already mentioned, we have a Telegram page. Please join the Telegram page and you would certainly enjoy it. Trust me, you'll certainly enjoy it. Now, today we'll be talking about planning, audit planning. Then we'll be talking about risk, we'll be talking about controls, a bit about controls as well. So let's dive in right away. What is audit planning? We cannot talk about audit planning without talking about the Audit Strategy Memorandum. Planning is a strategic initiative, it's a strategic effort, to be able to outline the thought process behind an audit. Most auditors prepare an audit strategy memo. And remember, we said it's a memorandum, so it's a document that sets out the main points involved in the planning process. So the main points involved in the planning process, this audit strategy memorandum will set that out. And any decisions that have to be taken, the audit strategy memorandum gives us those details. So you might be asking, what does this memo cover? It covers the assignments, objectives, and reports to be issued. What are the objectives of the assignments, right? So if you are going to audit a particular thing, what are the objectives? We would want to understand that. And what kind of reports are we supposed to issue? Those are the outputs. Another key thing in the audit strategy memo, you're talking planning here. So certainly the audit timetable. The audit timetable will include the different tasks in the audit, as well as the deadlines to meet them. Audits, it's all about deadlines, meeting deadlines, because we need to audit the financial statements and usually these financial statements are published. And so the audit timetable gives us the task and the deadlines. The audit strategy memo also gives us information about changes in the client's organization. And that's useful information because you want to understand what kind of changes have occurred in the client's organization and how does it impact the audit? How does it impact the audit? Very, very important. Very, very important. Okay. Another thing we know that's also important in the audit strategy memo is a summary of key financial ratios from previous years. So some financial ratios, financial ratios gives you a bird's eye view of the financial performance of an organization. So some summary financial ratios from previous years certainly will be helpful in that regard. Then it also includes planning decisions for the audits as well as staffing requirements. We cannot talk about audits without talking about staffing requirements. So the people who would work on the audits, the number of hours they would work in order to achieve our goals. Now let's talk about the information that is required to effectively plan an assignment. This information certainly has to be relevant. Now, ISA 300, which is the International Standards on Auditing 300, which is planning and audit of financial statements, requires the auditor to prepare an audit strategy and an audit plan. So I needed to bring that to light. ISA 300 is saying that it is wisdom to prepare an audit strategy. It is useful to prepare an audit strategy. It's very, very key. So please, I need you to keep that in mind. This is a requirement of the international standards of audit on auditing. Very, very important. Very, very important. Then ISA 315, which is identifying and assessing the risk of material misstatement through understanding the entity and its environment, also requires the auditor has sufficient understanding of the entity and its environment. One of the things we talked about in Audit Strategy memo is that it captures the changes in the client's business. You need to have an understanding of the client's environment, of the entity, in order to understand the risks that face them. And as we all know, the risks gives the auditor relevant information as to how to go about the audit. Very, very important. Very, very important. So let's look at, we talked about information required to effectively plan an assignment, right? We talked about relevant information, and not all information is relevant. Not all information is relevant. So yeah, we are looking at relevant information. So what are some of the things that you need to effectively plan an assignment? A common exam requirement involves a scenario that misses out some information that will be relevant to the auditor, either for planning or executing the audit. You may be asked to identify any additional information required. For example, obtain a copy of a new loan agreement with the bank to ensure details of any overdraft limits. So this is relevant information, right? If you want to understand the overdraft limits and the debt covenants your client has, you need to get a loan agreement from the bank. It's very, very simple. If you also want to understand the impact of lawsuits on your clients, you need to review legal correspondence between the clients and their legal advisors. Very, very important. So these are some of the relevant information that we're talking about. Now, what do we refer to as non-relevant information? Remember that materiality is key when it comes to audit. We said that the objective of the audit is to identify whether material misstatements exist in the financial statement. Therefore, information that relates to immaterial matters that will not assist in concluding whether a material misstatement exists may not be relevant for audit planning. So here we are looking at material things that have an ability to influence the decision of users. If it's not material, we do not necessarily focus on it. Now, let's talk about risk. Now, there's what we call the risk-based approach to audit. The risk-based approach to auditing. A key feature of modern auditing is the risk-based approach that is taken in most audits. And what happens at the planning stage, as required by ISA 300 and 315, the auditor will identify and assess the main risk. So we already talked about ISA 300 and ISA 315, where the auditor will identify and assess the main risk associated with the business to be audited. The main risk. Because the risk would help you to shape your planning process. Now, when the auditor has been able to identify and assess the main risk, what do they do next? The auditor will then design and implement appropriate responses to those assessed risks. The auditor will then design and implement appropriate responses to those assessed risks. So after you've identified, the auditor has identified the risk, assessed the risk, then the auditor has to design and implement appropriate responses to deal or handle those risks, basically, in accordance with ISA 330. Very, very important. So you see how it works. Identify the risk, you assess the risk, you design risk responses and implement them. Now, the audit risk model is an interesting model. And it's available to help auditors identify and quantify the main elements making up overall audit risk. The main elements making up overall audit risk. Audit risk is the risk. So what is audit risk? It's the risk that the auditor will reach a wrong conclusion on the audit. So, we said that auditors give opinions, right? If you haven't watched my previous lectures, please do so. So that auditors give opinions, and this opinion has to be correct based on the evidence they were able to audit, but audit risk is the risk that the auditor will go wrong in terms of the opinion that they give. So let's say they give an unqualified opinion, but actually they were supposed to give a qualified opinion. So that there's a risk inherent in that. The audit process is designed to give a high level of assurance about the information that is subject to the audit. High or reasonable level of assurance. What you need to know that the audit process does not give absolute level of assurance that the information is 100% correct. It's very, very important. Audits do not give 100% assurance or absolute level of assurance because the auditor did, based on how the audit work is done, the auditor does not test every single transaction. The auditor deploys a technique called sampling. He samples a portion of the population and tests it. So the auditor does not give 100% assurance. They give a reasonable level of assurance or a high level of assurance based on the testing they've done. Please keep that in mind. Now, audit risk model. What is the audit risk model? It's simply audit risk is equal to inherent risk times control risk times detection risk. Please, this is very, very important. It's just like in accounting, you need to know the accounting equation, which is asset is equal to capital or equity plus liabilities. In audit as well, you need to know this formula. AR is equal to IR times CR times DR. AR is audit risk, IR is inherent risk, CR is control risk, and DR is detection risk. Now, what is inherent risk? What is inherent risk? Inherent risk is the risk that items may be misstated as a result of their inherent characteristics. Because of the nature of the item, there's already a risk existing. So what does this mean, right? Inherent risk can result from the nature of the item, the nature of the entity. Two things: the nature of the item or the transaction, and the nature of the entity or the industry in which it operates. So there are some industries that are inherently risky. They have some inherent risks. That's very, very important to know. So let's look at the nature of the item. For example, estimated items are inherently risky. When you throw out an estimate, it's inherently risky because it could be an estimation is not the actual thing. So it could be right or it could be wrong. And so that makes it risky. Then what about the nature of the entity? For example, there are certain industries that have some inherent risks, right? That have some inherent risks. So, for instance, let me give a typical example. Here we say the construction industry, it operates in a very high risk environment. operate in a high-risk environment because in the construction industry, what happens is people borrow, because of the intensive capital nature, people borrow to fund projects, and it's possible that they may not be able to pay back and all of that. So there's some risk. Every industry has their own risk. So the risk is inherent in the nature of the entity and the industry which it operates. So inherent risk, as you've realized, operates independently of controls. So no matter the controls you set, it's not able to capture inherent risk. Inherent risk operates independently of controls and cannot be controlled. So the auditor must accept that these risks exist and will not go away. Very, very important. Very, very important. So this is an inherent risk. It's part and parcel of the item or the industry. Now, let's look at the assessment of inherent risk, right? The auditor's assessment of inherent risk will be mainly based on their knowledge from previous audits. They also assess the environment. We talked about environment earlier. So they'll assess the environment. It's very, very important. So this gives them some information about inherent risk. And you can assess inherent risk at the financial statement level or the transaction level. So at the financial statement level, the auditor will consider the inherent risk in the client's business, such as the integrity, skills, and abilities of management, the nature of the business, as well as industry-wide or macroeconomic factors. These are inherent risks, right? That's at the financial statement level. At the financial statement level, they will consider inherent risk like, what is the integrity of management? What is the nature of the business? We talked about this earlier. And what are some of the macroeconomic factors? So, for example, if you want to set up a business in this COVID environment, there's some inherent risk, because of the nature of the business environment within this period. At the accounts balance and transactions level, the auditor will consider the degree of subjectivity involved in the account balance of the transaction, the degree of complexity of a transaction, how complex this transaction is, what are the characteristics of the client's assets and the extent to which they can be misappropriated. So when you look at the transaction level, you need to look at how complex the transaction is and what is the subjectivity that goes into it. It's very, very important. Now let's talk about control risk. Let's look at control risk. What at all is control risk? What at all is control risk? What at all is control risk? Control risk is the risk that a misstatement will not be prevented or detected by the internal control system that the client has in operation. So the control risk is the risk that a misstatement will not be detected by the internal controls of the client. In preparing the audit plan, the auditor therefore has to make an assessment of control risk for different areas of the audit. It's very, very important. Very, very important. Evidence about control risk can be obtained through testing controls. The initial assumption should be that control risk is very high and that existing internal controls are insufficient to prevent the risk of material misstatement. It's very, very important. Very, very important. The initial assumption should be that control risk is very high and that existing internal controls are insufficient to prevent the risk of material misstatements. We said here that it is unlikely that control risk will be zero because of the inherent limitations of any internal control system. every internal control system has its inherent limitations, right? It's human beings that design the control, so it's inherently risky. So it is very, very unlikely that control risk will be zero. Now let's talk about detection risk. Detection risk is simply the risk that auditing testing procedures will fail to detect a misstatement in a transaction or in an account balance. A misstatement in a transaction or an account balance. A misstatement in a transaction or an account balance. So you see here, we have shifted to the auditor, right? Is the risk that the audit procedures will not be able to detect a misstatement in a transaction. It's very, very important. So in control risk, it was more dependent on the client's internal control. Detection risk, we are looking at the audit testing procedures. In preparing an audit plan, the auditor will usually set an overall level of audit risk. An overall level of audit risk. He will also assess the levels of inherent risk and control risk, and he will adjust the level of detection risk in order to achieve the overall level of risk in the audit. It's very, very key. It's very, very important. So I'm sure you're understanding what detection risk is here. So detection risk, we are here, the mantle has fallen on the auditor and his testing procedures. In other words, what it means is that the detection risk can be managed by the auditor in order to control the overall audit risk. As noted above, inherent risk cannot be controlled. It cannot be controlled because it exists independently of controls. It's as a result of the nature of the business. It comes with how the business is. So you can't really control it. It's like if you are going into a certain kind of business, there are certain risks that come with it and you cannot necessarily control. Control risk can be reduced by improving the quality of internal controls, and detection risk, can also be reduced by, improving the extent of your testing or the quality of your testing as well. So you see, audit risk comprises of inherent risk, control risk, and detection risk. So you see how they are all interconnected. So never forget this chart. It's very, very important. And this is basically a summary of everything that's happening here, right? To achieve a target level of audit risk, one thing you need to know that if inherent risk and control risk is high, if your inherent risk is high and your control risk is high, then you need a very, very high level of audit testing. You need to test more because the risk is high in order for your detection risk to be low. If your inherent risk and your control risk is high, then your detection risk must be low. So if your detection risk is low, what does it mean? It means that you need to test more because you are trying to bring your detection risk, the risk of detection, low. So you'd do a lot of testing in order to uncover any misstatements. So please don't let it confuse you. If IR and CR, inherent risk and control risk, is high, then your detection risk must be low, right? Inherent risk and control risk, if it's high, it's too high, then you can't afford for your detection risk to be high. Otherwise, you are aggravating the problem or you're intensifying the problem. So your detection risk must be low. If your detection risk is going to be low, what do? You test more. Just like you're going to write an exam, and if you don't want your risk of failing to be high, what do? You go through your work. You make sure everything is okay. So a high level of testing will be required, and so will require a larger number of sample sizes. If your inherent risk and control risk is low, then you don't require to do a lot of testing. Then your detection risk must be high, and you focus on smaller sample sizes. So you see the relationship. If inherent risk and control risk is low, the auditor doesn't have plenty of work to do as compared to when inherent risk and control risk is high. If inherent risk and control risk is low, then there's a lower level of audit testing. And so detection risk must be high, and smaller sample sizes will be involved. I hope the picture is clear. It's very, very important. Very, very important. Now let's look at the connection between business risk, financial statement risk, and detection risk. Let's look at the connection between business risk, financial statement risk, and audit risk. So what is business risk? Let's first of all understand that. Business risk is any risk that threatens the ability of a business entity to achieve its objectives. And you know the fundamental objective of businesses was to achieve profits and maximize shareholder wealth. It's very, very important. Very, very important. So that's very, very key. So now we have an understanding of business risk, right? It's very, very important. So we said here that anything that threatens this objective is therefore a risk that profits might be lower or the objectives of the organization will not be achieved. So that's with business risk. Now, for applicable risk, management should decide on a suitable plan or strategy for managing the risk. The chosen strategy might be any of the following. So these are ways to manage risk. You can reduce the risk, you can transfer the risk, you can avoid the risk entirely, or you can accept the risk. Number one, we can reduce the risk. How do you reduce risk? Just think about it. You introduce more internal controls. How do you transfer risk? You transfer risk. A typical example is through insurance. You avoid risk entirely. You just, you just avoid it. You don't go into it at all. You accept the risk. You accept the risk and try to handle it. Now let's look at business risk and financial statement risk. You should know that the business risk can have an impact on financial statements risk, right? Most business risks increase the likelihood that the financial statements could be materially wrong. So definitely business risk will have impact on financial statements. Some business risks can be linked to specific financial statement risks, such as the risk of an understatement of bad debts, overstating the value of inventory, or overstating the value of a non-current asset. So you see how business risk could impact financial statements. And just look at the kind of risk that is being listed here. What the client might seek to do is understate liabilities and overstate assets. If the client is trying to cheat on their financial statements, they will understate liabilities and overstate assets. Anything that is positive, like revenue, like assets, they'll try to overstate it. And anything that is negative, like liabilities, like expenses, they'll try to understate it, just so their financial statements look good. So that's where the financial statement risk lies. Now, audit risk and financial statement risk. Business risk is a risk that management must deal with. Audit risk is a risk that the auditor faces. It is the risk that the auditor will give an inappropriate audit opinion, which we already talked about. Audit risk follows on from financial statement risk. The auditor should therefore assess the financial statement risk as a step towards assessing audit risk. So you see, it starts with business risk, number one. Number two, financial statement risk. Number three, audit risk. So when business risk is very, very high, financial statement is very, very high, and the audit risk too, the auditor really needs to watch it because it's going to be quite high. And it's likely to be high, and they have to find ways to manage that risk. Very, very important. Very, very important. So the audit risk follows on from financial statement risk. The financial statement risk follows on from business risk. It's very, very important. We've already talked about audit risk being inherent risk, control risk, and detection risk. So I wouldn't go into that too much. We said here that the types of risks to consider, we said here that the risk of overstatement of revenue, which is a positive thing, the risk of overstatement of current assets, the risk of overstatement of non-current assets, the risk of understatement of liability. So anything that is like a liability, there's a risk that the client will understate it. Anything that is like an asset, there's a risk that the client will overstate it. We talked about operating expenses. So if you look at something like expenses, right? Expenses, have to be deducted, so there's a risk that expenses reduce your profits. So there's a risk that the client will understate expenses. Very, very important. Very, very important. So these are some of the things we would talk about for today. I hope you enjoyed this lecture on internal controls and audit risk. Thank you for spending time with me to understand these principles. In subsequent editions, we'll be talking about, auditing using computers as you also, and talk about a few other issues. Thank you and have a good day.